Uh, 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 my name is Yuriko. You can call me Yuriko, Yuri, wherever you want. And this module is called the accountants in the accountants environment. We are talking about different topics, different different areas. So basically, this is an overview of the lesson of today that is going to be today on Monday. We are going to check four topics, 1 hour each one, depending on, obviously, if we need to extend the class, we can extend, or if we feel that with this knowledge that I'm going to share with you is enough, we could finish today to continue the next Monday with another model.
Okay.
So this is the topics that I'm going to cover with you, the 4 topics. And the topic number 1 is understand different business organizational structures. So basically, we are going to review the more traditional structures in corporations, in companies. It's very easy. And we are going to discuss what are the benefits and the bad things of every kind of a structure. And then we are going to talk a little bit about the financial reporting requirements from different business organizational structure. Basically, this is a content for the first topic.
Okay.
So let me put this here. Compare the features of different business organizational structure. What do you think that is an organizational structure, Kieran?
I guess
Only
it's
with
just,
your words, not something very complicated.
okay, that's fine. Just the ways that the company is set out, so like sort of the hierarchy and whatnot.
Exactly. Basically, an organizational structure is a system. It's a system in which we can find how the activities in a specific company organization is managed, is connected, how the different areas can communicate each other. So keep in mind that an organizational structure is a system. It's a system of communication in order to reach a certain goal, probably in a company that is looking for a profit. This goal is increase the profits, or maybe is another type of company that is looking for growing maybe in a certain sector. So this organizational structure is going to help us to communicate with others in order to achieve a specific goal. So then we have some scholars that have defined what is an organizational structure. For example, Bateman in 2009 said that organizational structures represent a different level of management, along with the responsibilities and position of the responsible people of the organization. So we have another element of inside the organizational structure. Know that we have not only a system, we have responsibilities, and we have position that determine how how the structure is going to be communicated. Another scholar said that every organization has the organizational structure that describes the flow chart of command and hierarchy of the management and controlling system and different level of management. So we can see that the concept of organizational structure is very similar, no, with different, probably with different words, but we have the same elements. So now we are going to review different types of structures. For example, we have here the most common structure, or the most basic structures, I will say, in which we can find, for example, if you see here, normally the companies have here a CEO that is the person that governs and that say how the things or how the activities are going to be doing. So basically this is the most common structure. So then a CEO, then the CEO has another person that this CEO is going to supervise. Probably depends on the organization. These people could be managers, could be directors, could be, I don't know, maybe supervisor, depending on the size of the company. And then these people, let's say that these people are called managers. No, the manager has another people to say what are the activities that they need to cover in order to report to the CEO and the CEO to the board of directors. Have you heard about the board of directors?
Yes.
Okay, can you tell me what is your knowledge about the board of directors? Who are these people?
So they're just sort of people who sit, I don't know, above the CEO, and they're sort of the people that make the big decisions within the company.
Exactly, and the board of directors normally is in the board of directors we can find the owners of the company. So normally the CEO reports all the problems, all the issues, all the performance of the company to these guys that basically they are the owners of the company. So board of directors depend on the sectors and depend on the necessities of the company. Normally they have, for example, an audit committee, or they have, for example, a compliance committee or risk committee, additionally the owners, and additionally some people that used to give advices to get better results. So yes, basically board of directors, as you say, are the people that take the most difficult decisions sometimes. Okay, so in this structure that is very basic, one of the benefits of this structure is that the responsibility of each member is well defined. So because we can find each level, each person with a certain level of responsibility. So it's easy because, for example, if we are a staff, no, let's say that this guy is an staff, no, this guy can report any issue to the managers. So it's easy to communicate ideas or problems. So it's the authority and responsibility is well defined. But what would be a negative part in this structure? That maybe the guys that are in the lowest level could have this feeling that they have an obstacle to communicate their ideas to the CEO, because maybe they could feel that they need to tell everything to these guys, to the manager, in order to to reach the CEO. So the interaction is not very direct. So this is one of the cons of this structure. No, we have on one hand responsibility and authority, but on the other hand, in a negative part, maybe the communication is not very direct, and maybe the lowest levels could feel not listened. So this is one of the cons, but basically this is this is a normal structure that all the companies have. And then we have, do you have any question about this structure?
No,
or do
no,
you?
I think that's okay. With that one especially, yeah, that one's fine.
Okay, that's right. So then we have this another structure that is, I would say that is more, that is plain, a little bit more plain. So this structure is called function structure. And same as the previous one, this structure shows different levels. Here we have the head of IT, but the difference between the other one, between this one, is that in this structure is general. If you can see, here we have the board of directors, the CEO, and the rest of the people. But here we have a specific guy that is specialized in a specific area, is the head of IT. So in this kind of a structure, these these graphs, these maps are made only by with a specific area. For example, here we have the head of IT, and I'm pretty sure that, for example, this head of IT could be, if we compare this one with this one, could be this head of IT could be part of this level, no?
Okay.
So the thing is that this structure is more specific because this structure is divided in specific areas. And after this guy, we have another that, for example, this guy is an expertise in security engineering manager, and we have different, no, different people that is specialized, maybe between the IT, but with different skills. And every part of this level has another levels. And for example, this guy has two another levels, but with different knowledge. Even when these two girls report to the same guy, their specialization is different. So this is another kind of a structure. One of the benefits is encourage specialization, and one of the cons is that makes the communication between departments or between areas are complicated because of the specialization. Imagine that one guy is the best in, for example, security engineering, and how this girl is going to communicate her ideas to the rest, because maybe she is the expertise, and maybe this guy that is not the expertise in security engineering, she doesn't understand the work of this lady. So one of the cons could be that it's difficult to communicate ideas because of the level of specialization of each area. So this is another structure. And the third structure that we are going to check is the flat structure. This structure is very common, not for all the companies, it's for the companies that are starting for a new business, for example, the startup business, because they are planning how to create a structure. So maybe this kind of companies that are not very big, or they are not very, like, they don't have many people, they need to create a flat structure because of the number of people. So this is not common, it's common, but for small business or medium business, but not for all the companies. So one of the benefits of this structure is that boost the open communication, because this structure doesn't have a lot of levels, so the communication is direct and all the ideas could be listened to. So this is one of the benefits. And one of the cons that is because it's flat, maybe the employees could be deal with many issues about reporting. Who is supervising? Who is the guy that is reviewing and that is monitoring that all the activities are well done? So this is one of the cons, no? That because it's very plain, we don't have these levels like in the previous two structure. So it could be create many problems and confusion. So this is another structure. And then we have the opposite with to this structure that is plain, that is for small business. We have a divisional structure that I feel that this divisional structure is when we see the whole picture with the function structure, because function structure we can see only one part, and divisional structure we can see the whole picture, no? The divisional structure is created by different function structure. So if you can see, we have different areas or different departments, and this divisional structure is more for big companies, for companies that have this maybe economic successful, that they know the operation of the company, and for that reason this company has recognized the necessities depending on the operation, and for that reason these companies has created many division according to the operation or according to the business. So one of the benefits is that that all the areas can get a quicker response, because every area has a lot of people and a lot of expertise and a lot of people that know specific issues or a specific area, so the response is quicker. And one of the cons is that the competition, because obviously if every department has a lot of people, obviously the competition is going to be high, because every area has more position to be taken, and it creates it creates competition that in certain point is good, but in another point it could create a stressful environment. So this is a divisional structure, and this is a structure that a big company used to have. Have you ever seen this structure in one company?
The divisional structure.
Mm-hmm. Okay, yes, it's the most common, I guess, and I feel that it's a common, and it's because I feel that the biggest companies in every country, they put a lot of information in their webpage, and we can see this kind of a structure, no? Who is the leader, who is the manager of every area. So yes, you're right. Okay. Till here, any question about the structure in an organization?
I think that's fine.
Okay, that's right. So now we are going to review the financial reporting requirements for different business and organizational structure. Now we review the structure, and now we are going to see what are the requirements in terms of financial reporting. Uh, Normally, one of the interests that many investors have is how is the performance, the financial performance in each company. No, so for that reason, the company need to cover different financial reporting in order to show what is the financial situation and to show to this investor if the company has good or bad results. And additionally, this financial reporting helps to make correct decisions, make more informed decisions. So for that reason, some sectors, probably in financial sector, in health sector, in all this kind of sector, these companies or these industries needs to send or need to show financial reporting.
Okay.
Why? Because a strategic decision, as I said, and because there are a lot of stakeholders that want to see what is the performance of the company to see, to take decision or to change decision, to improve or to do or to follow or to reach a certain goal. And in all the sectors, we have four important and four basic financial statements. We have more than this, but the mandatory or the obligatory financial statement are four. One of these is the balance sheet. Have you heard about financial statements? Have you, or do you know what are the financial statements?
I've done about them in sort of GCSE and A-level business.
Okay, so the first of these four financial statements, the first one that is mandatory is called the balance sheet. The balance sheet basically shows the financial position of the business in a certain point of time, because this statement, for example, could be at 31st of December of 2020. So it means that this is the financial position of the company on this period. So this is very important. And also balance sheet shows the assets that the company has, and the obligation and the equity that all the owners of the company have invested in the company. So basically show everything on the company in terms of obligation, rights, and investment. And this is how a balance sheet looks. For example, normally, if we have the opportunity to see a balance sheet of a company, we can find the name of the company, obviously, in the first line, and then the name of the financial statement, that in this case is the balance sheet, and then the period. In this case is December 31st of 2016, but we can have the balance sheet maybe in 2020, maybe in 21, or in different date. So as I told you, here we can find the assets, all the rights, all the things that the company owns. For example, we can find here cash, securities, inventory, all the things that the company has, all the things that the company has bought with its money. In the right side, we have liabilities. Liabilities are all these obligations that the company has. For example, account payable, maybe the company bought inventory, but the company hasn't paid all the inventory. So this debt is an account payable. So this is an obligation because the company needs to pay this inventory, but the inventory is the owner is the company. So on this side we have rights, but in this part we have obligations. And in this part, we have all the money that the owners of the company has invested. For example, if we started a company, we would need to invest a certain period, a certain amount of money to start the company. So this money that we deposit and that we need to have to start a company needs to be registered on this part. And additionally, in this part, we can find the profits that the company has every year. So basically, in owner's equity, we can have the retained earnings and the money that the owners invested at the beginning of the business.
Okay.
So the second financial statement is called the income statement. This is a little bit different. This statement shows the profits that the company has. Is different from the balance sheet, because remember, the balance sheet shows the position, the financial position in a certain period of time. But in terms of income statement, the income statement is going to show us the profits at the expenses that the company has had during 1 year. So we can have here, for example, if we are a bank, imagine that we are analyzing the income statement of a bank. We can have, for example, at the beginning of the statement, what was the income of the bank, and the income of the bank can come from the interest that the clients used to pay to the bank, or maybe these fees of that the clients pay for having a credit card. So this is the source of the income. And then we are going to see the expenses. Maybe the bank has expenses related to the creation of credit cards. So income minus expenses, we are going to have a profit, no? And then we have different concepts that are going to decrease or increase this profit depending on the operation of the bank, no? In the example of the bank, or depending on the operation of a certain company. And basically, this is how an income statement is created. For example, here, same as the balance sheet, we are going to find the name of the company, the period, the name of the financial statement, and then this is different from the balance sheet, because now we are going to start with income, and we are going to divide here with the different operation of different sources of income that the company has. And then we're going to decrease all the expenses that related with the operation of the company. And then this is a very important part that we have here, tax expenses, because at the end, if you know, every person, every company needs to pay tax. So this financial statement considers these expenses related to tax. So after tax, after different concepts, I repeat, these concepts are going to be related depending on the operation of each company. So after these two concepts, income and expenses, we are going to decrease the tax expenses, and then we are going to have our profit, or if obviously the company has a profit, or a loss if the expenses were bigger than the income.
Okay.
So this is a very simple example to show how the income statement looks like. So then the fourth financial statement is called the statement of stakeholders equity. So basically this statement, if you remember, in the balance sheet, I told you that we have here all the money that the owners of the company has invested, or all the money that the investors or the owners of the company has earned. So the statement of stockholders equity is like a very specific picture of this part of the balance sheet. We are going to see deeply how this part is organized. So now this picture shows how a statement of stockholders equity looks. So for example, we start with a period in a year and this is very important. In this statement, we are going to find the stock. I mean, if we are going to invest in a company, we are not going to deposit the money and that's it. We need to receive a stock. If we are going to invest, let's see, in Apple or in, I don't know, in Coca-Cola, I'm going to invest my money, but when I give my money, I'm going to receive a paper that is called a stock. So it means that I'm investing in a stock in a certain company. I gave my money and I receive a paper that this paper is called a stock. So in this statement, we are going to find the stock or the money that I invest in order to get this stock. I don't know if I'm clear in this part.
Yeah.
Okay. So, and additionally, during the year, imagine that we invest more money in this company. So it means that we have more stock. So obviously, in the example, we can see the money that we have when we start the year, and then during the year, probably we invest more money. So we have more stocks. So we are going to find here this money that we invested. And additionally, in this part, in the next columns, we are going to start with the earnings that we earned in the previous year. And additionally, the earnings that we are going to have in this year. So if you see, we start in January and we close in December, because we are tracking here in this financial statement all the changes and all the investments that we have during the year. And if Imagine if then we notice at the end that at the end of the period that at the end of the period we have a profit, and in this profit we need to get a dividend. So normally when the owners of the company want to get money from the company, this money that the owners receive is called a dividend. So this dividend decrease the profit of a company. So for that reason, we can see this figure in red because it is decreasing the money that we have earned and the company has earned during the year.
Okay,
So
so the dividend comes out of the profit for the company.
exactly.
Okay.
So when we have, for example, imagine that the company has a profit, and because the company has a profit, the owners of the company thinks, okay, I want to my dividend, I want to get money. So the board of directors has a meeting and they said, okay, we are going to pay dividends to the owners, and obviously these dividends are going to decrease the profits of the company. So for that reason, we can find this in red, or that this is decreasing the profits of the company. It's right. Did you understand that?
Yeah, no, that's fine.
Okay, and remember, dividends, when the company are going to when the company is going to pay dividends, the dividends are paid after taxes. I mean, the company decrease the taxes, and the figure or the amount of money after taxes is divided, or is the amount that the company takes to give dividends to the owners of the company. So this money doesn't have taxes because the taxes has been reduced. And then finally, we have our fourth financial statement, that is called a statement of cash flows. Basically, this statement shows what are the inflows and the outflows of the company. So this is not something that it shows the financial position or of the company. This statement of cash flows only shows in which activities the company has paid in cash, or in which activities the company has received cash. So basically, for that reason, this statement is called cash flows, the statement of cash flows. And this is a picture of the statement of cash flows. For example, we start here with the net income. Then we have this depreciation, because I don't know if you know how is depreciation.
Like the devaluing of the money.
Okay, for example, imagine if the company gets a car. So after 1 year, the value of the car is going to decrease, because if the company wants to sell this car after 1 year, the company is not going to receive the same amount of money that the company paid when the company got a car. So this decreasing of the value of the car is called depreciation, because the asset, in this case the car, lost value in the market. So depreciation is like a decreasing of the value of an asset, a car, or for example a building, or for example I don't know, another vehicle, or every asset that we have decrease their value in the market. But in the case of, for example, land or for example, houses, or for example, building, they tend to increase value. So the opposite of depreciation is amortization, is when the value of a certain asset increase instead of decrease. But if we compare, for example, a car, the car is going to decrease value in the future, but maybe a land is going to increase. So this is the basic concept of depreciation and amortization. But depreciation or amortization is not a cash flows. At least you sell the car, or at least you sell the building. So for that reason, in the statement of cash flows, we need to add the depreciation, and we need to decrease the depreciation, because this is not a inflow or a cash flow or a outflows. This is only losing value, but we have this cash only when we sell this asset. So normally we can find depreciation. We are going to decrease depreciation. We are going to increase depreciation if we didn't sell the asset. But if we sold the asset, we are going to increase depreciation. I don't know if it's clear. It's clear? I was
No,
clear.
yeah, that's fine. Yeah.
Okay, so we have a different, if you see in this statement of cash flows, we have three different segments. We have cash flows related to the operation of the company, or we have, for example, cash flows related to investing. For example, here we have equipment purchases. Maybe the company is investing in a new plant, in a new, probably in a new building, in maybe in a new platform, in maybe in computers. So this is related to investing. So then we have these financing cash flows that are all the activities related to financing. For example, if the company got a loan, or the company was lent money. So these kind of operations are going to be here in financing. So this is very, very important, that in a statement of cash flows, we are going to find three different segments. Activities relating to the operation of the company, activities related to investing, or activities that are related to financing. So we need to divide the operation of the company into three different segments. I'm sorry, Kieran,
Okay.
but
No
but
worries.
but my internet, I don't know why I got disconnected. But I'm going to teach you the last slide, and then we can talk. We can take a break.
Okay.
Okay. No, I can share my slide. Okay. So the next slide was related to unlike the financial reporting requirements. We continue to talk about the financial reporting. So here in the UK, the financial reporting requirements, we have a law called the Companies Act 2006 that,
I
yeah.
can't see your screen.
Yes, I'm so sorry because
It's okay.
I'm not the host, so I
Oh,
cannot
do
share
you want me to
my
make you
screen.
host? Okay, that's fine.
So I need to be the host, so I'm going to talk with
It's fine.
the university.
I made you host
Ah,
now.
yes, I'm the host right now, so I'm going to show you my screen. Um, okay, so I was telling you that here in the UK we have a kind of rules, a kind of law that is called the Companies Act 2006. That this law says all the okay, the reporting regulation that the UK, all the companies held here in the UK need to follow. So one of these reports is annual accounts. Annual accounts, it means that these annual accounts reports include the four financial statements that I told you: balance sheet, the income statement, cash flow. These four financial statement that I was talking about. So basically, this is the annual accounts, and these annual accounts needs to cover two important frameworks. One of these frameworks is International Financial Reporting Standards, or known as an IFRS, or the UK GAAP. So basically, these frameworks are financial rules to present financial information. So additionally, the Companies Act says that another mandatory report for the companies that are operating here in the UK are the strategic report, except small companies and micro entities, no? But the medium or biggest companies, or big companies, used to cover this strategic report. That's basically, this report is contains all the future plans of the company, you know, how the company is going to react in the future, or what are the services or the products that a company is thinking to launch in the future. And the third report that the Companies Act says that the companies need to cover is the director report. That basically is like a letter, or is a report that the directors of all the companies needs to prepare to show how was the performance of the company during the previous year, and what are the things that this director are going to expect in the future. So a strategic report is more related to the business, and director is more related to the manage that the director is going to have in the future, and the manage that the director had in the past. So remember this act, the Companies Act 2006, that talks about the mandatory reports that the companies in the UK needs to cover. So till here we have covered the first topic. So let's leave the class 10 minutes, and in 10 minutes we come back, or do you think that we can continue? What do you prefer?
Is
Stop
this a,
here, 10
is this,
minutes. Huh?
is this supposed to be 2 hours?
Yes. No, but what do you
Okay.
prefer? Do you prefer that we take 10 minutes break now, or continue and maybe we can finish a little bit earlier?
I didn't realize it was 2 hours. I thought it was just 1 hour. We'll just go straight through.
Okay, so do you prefer to continue or to take a break of 10 minutes?
Just continue.
Continue, okay. So topic number 2 is we're going to understand the external environment in which a business operates. And for that reason, for that topic, we have one methodology that we are going to review that is called STIL. That basically are all the internal and the external factors in a company that affect a company. So PSTIL is an acronym to identify macro or external factor that has an organization or a company or a business. And the letters of PSTIL means political, economical, social, technological, environmental, and legal requirements. For example, in this analysis, the company needs to think about what are the political factors that could affect its operation. For example, could you tell me one political factor?
I don't know, Brexit or something.
Exactly. For example, Brexit is one political factors because probably the companies that are operating here that maybe are from the European Union need to follow now the UK rules, no? And probably they need to change some things about regulation because of the Brexit, no? Or maybe, I don't know, companies that are operating in another countries, depending on how the country is facing the Brexit, they need to change or to modify some process on some rules because a political factor is affecting the operation of certain companies. Even in political factors, we can find taxation, policies, sustainability, and trading. So we have many political factors, but it's very important to analyze political factors and how these political factors or political issues could affect the operation in a company. And then economic factor. An economic factor has impact on the performance of the economy and its performance. No, it's not the same, for example, having a business in a very powerful country, maybe here in the UK, maybe in the USA, maybe in Switzerland, and maybe in a developing country, no, that the economic conditions are not good enough to face different economic activities. No, for example, I feel that because the UK economy is very strong, we can find here a lot of banks, a lot of activities related to financial sector. But let's see, for example, in a developing country, let's talk about Latin America, no? In which many of people are facing problems directing to financial inclusion, or for example, in Mexico, it's very common that people don't pay taxes because because the salary, for example, in Mexico is too low, and most of the people thinks, okay, if my salary is low and then we need to decrease, I need to pay taxes, obviously my salary would be less, so I'm going to find ways to avoid taxes, no? But this is very, very related to the economic situation of the company, of the country. So this could be an economic factor. Could you tell me an example, a very specific example of economic factor?
I don't know, sort of like recession or something like that. If a recession was going on.
Mm-hmm. Recession, for example, in Argentina, they have a very huge inflation, or in Venezuela, no, that they are suffering a recession. So yes, this is an economic factor. Another thing is a social factor. When we are analyzing the company using this methodology, still, a social factor is another category that affects the performance of the company, the performance of the business. But the social factor are more focused on the environment and the trends of the in population. No, let's think, for example, in smartphones, no, that I remember that one day, when I don't remember what was the model of the iPhone that was on this occasion, but I remember that in one occasion I was in New York, and I saw a very, very big row outside the Apple store, because Apple was launching the new iPhone. So you can, I feel that this is a social factor, how the people react when a new product or a new service is launched. No, so I feel that this is a social factor that maybe Apple created, no, because Apple created the necessity to have the last iPhone. So this is a social factor. And now, because of the social media and because we are more connected through technological devices, maybe social factors are changing. Maybe if we think on working remotely in 10 years ago, we would never imagine that it could be possible. So now we are working, we are teaching, we are learning through distance. So these are kind of social factors that are affecting the operation of the company. Or imagine, for example, another social factor that is happening, and now with this COVID situation, a lot of, for example, Netflix, Amazon Prime, these kind of platforms are very, very famous because social factors and maybe economic factors, and not political, but maybe social factor, economic factors, or external factors made that this platform were very successful. So this is another social factor that I can mention. And then technological factor. Technological factor obviously includes all the innovation in technology, innovation in platforms, in devices, in digital technology. Now we can find many examples now with a lot of platforms like Zoom, like Teams, or maybe in another sectors, for example, in the financial sector with the cryptocurrencies, or paying with contactless, or for example, in another sector maybe in gaming, no, that now we can play video games with another guy in another country, in another place. So depending on the core of the company, we need to consider technological factors. And I feel that factors are very important, because technology is innovating constantly and very, very fast. Can you mention another technological factor?
I'm not sure really.
For example, technological factor could be this situation with the smartphones, no? That which is the brand that offers the best camera, or the best software, no, to playing games. So we have many examples of technological factors, no, because as I repeat, no, technology is moving very fast every day. So these are the segments in which this analysis, this PCL tool is helping to the companies to get better analysis in order to be more profitable, or to reach specific objectives and goals. And we need more to another factors, environmental factors, that now is very famous, that all companies are socially responsible. In fact, we have something called corporate sustainability responsibility. That is a report that now most of the companies are presenting. This report talks about what are the changes in terms of sustainability that the companies are going to follow. And obviously, if we can find a company that has a corporate sustainability responsibility report, we are going to connect more with this company, no? Because maybe as a public, as an investor, we can feel more connected with those companies that are worried about the sustainability, to be more sustainable. And legal factors, this is another factor that the companies needs to get in consideration, because according to the country, according to the sector, the companies needs to follow certain rules and certain standards and frameworks. So legal factors are really important, because any company want to work against the law. And this is a brief description in which we can explain the key PCL factors that explain the PCL analysis. And one of the advices to get a very good PCL analysis is get a group of people from different areas, maybe the expert maybe the expert in economic factors, one expert of the social factor. So in order to brainstorm ideas. Even the company can seek opinions of experts from outside the business, maybe a consultancy firm, or maybe researcher. So PSIL analysis invites to get opinion not only from the employees inside the organization, but also outside the business. And then the other recommendation is researching and gathering evidence, how we can support every factor, and obviously how to know that our analysis is proof. So if we are saying in this analysis, okay, Brexit is a political factor, okay, how we can prove that Brexit is going to be a political factor, no, is to have evidence how this political factor is going to impact and what is the evidence. And basically this is some ideas in which some advices to get a better PSIL analysis. Okay, now we are going to explain the number 3, the topic number 3. And now we are going to understand the professional and ethical principle. We are going to explain till here. Do you have any doubt?
Sorry, speaking to me.
Do you have any doubt till here?
No, so far it's fine.
Before to cross to the next topic? Everything is fine?
Everything's fine.
Okay. Now, in this topic, we are going to understand the professional and ethical principles, the key principles of ethical behaviors. We are going to talk about the confidentiality and data protection. We are going to explain money laundering regulatory framework in the UK. And we are going to evaluate the impact of a branch of ethics on accountants and business organizations. So this model, we are going to review many concepts. Okay, here in the UK and in many parts of the world, we have these kind of bodies that regulates the accountant's profession. So one of these bodies is called Chartered Accountants of Ireland. That this body emitted a code of ethics for the accountants. And according to this code of ethics that was issued in 2020, we have some principles that govern the profession of the accountants, no? And these principles are very general. It's not, I feel that it's not that specific for the accountants, even when the body that emitted this code is a accountant body, but I feel that these principles could be taken not only for accountants, but also for lawyers or for economists. So for me are very general and are principles that every profession can take as part of a code of ethics. But this body obviously is very concerned about the accountant profession. So the first principle is called integrity. So integrity basically is to be very direct, very straightforward, very honest with all the work that the accountants used to do. So basically integrity is to be honest. For me, I feel that one synonym of integrity is honesty. So the code of ethics of the accountant invites all the accountants to have integrity. And the second principle is objectivity. It means that objectivity, as an accountant, we cannot we need to make adjustments, but based on evidence, not based on our feelings or based on our perceptions. We need to have evidence and be very, very clear and very, very like we need to avoid bias. So we cannot involve our feelings. So this is another principle, objectivity. We need to use objectivity in order to give a good result as an accountant. Another principle is professional competence and due care is when the accountant has all the knowledge about the profession, and the accountant has these skills and yes, and basically all the knowledge to cope with the professional, with the professional service that the accountant is providing. So it implies, for example, technical and professional standards and relevant regulation. And for example, one of the standards that the accountants need to know is, for example, international financial reporting standards. If we are of the accountant is an auditor, probably we need to have knowledge about international auditing standards, or depending what are the activities of an accountant, he or she needs to know, he needs to have the knowledge and this professional competency. So this is another principle in the ethical code. And another is confidentiality. Confidentiality is important because as an accountant, we receive a lot of information from the companies that sometimes is very, very like specific. And if we say this information to another person, it could cause a lot of problems. So we need to maintain this information in a safe place, because we don't need to spread this information, because if we spread this information, it could affect the operation of a certain industry, of a certain company. So we need to maintain all the information in a safe place and as a secret too. And the fifth principle of this code of ethics is professional behavior. Basically, professional behavior is when an accountant is concerned to continue with the same reputation, with a good reputation for the rest of the accountants. It means that as an accountant, I cannot act in a bad way, because it is going to affect the reputation of the rest of the accountants. So every accountant needs to act with a professional behavior in order to maintain a good reputation, not only their own reputations, but also the whole accountant's reputation. Till here, have you heard about another professional code and another code of ethics from another profession? Kieran? Have you heard about another code of ethics of another profession, not the accountant code? Maybe have you heard about maybe I don't know, lawyers code of ethics or doctors, or have you heard about another code of ethics?
No, not really. I assume they've got them, but I've not heard of any.
Okay. Perfect. So then we are going to talk a little bit more about the data protection. So we reviewed the code of ethics, but now we are going to review the data protection. That is an area in which here in the UK we have another rule called Data Protection Act that was launched in 2018. And this act controls how our personal information is used by organization, business, and government. So this Data Protection Act in the UK was implemented by the General Data Protection Regulation, or GDPR. And this act warranty that all the information that we give to an organization, to the bank, to the government, needs to be used fairly and lawfully and transparently. And also our information, because our information has a value in the market, the government needs to guarantee that our information needs to be used for specific and explicit purposes, that our information needs to use in a way that is adequate, relevant, and limited to only what is necessary. So if we are detecting that our information is being using more than the necessary, we can complain about that using this Data Protection Act, or make a complaint in the General Data Protection Regulation institution. So, and additionally, this Data Protection Act has the period in which our information could be used more than certain period of time. The companies that have our information need to delete all our information, or they cannot use our information anymore after a certain period of time. So, in fact, the Act has this area in which the Act specifies how our information need to be destroyed, and how the companies that have this specific information from us needs to be destroyed, needs to be deleted, in order to guarantee that the information is not going to be used in the future or for a longer period that is permitted under this Data Protection Act. And how the companies can get information from us. I don't know if you have seen, for example, when you are applying for a new position or when you are applying, for example, to study something new, you need to fill a form. And sometimes at the end of this form, you can find some specific question that these questions are called sensitive information. Is when in an application, for example, let's use an example. If you are filling a job form, at the end of the application, you can find this sensitive information related to race, ethnic background, political opinions, religious belief, trade union membership, genetics, biometrics, health, sex life, or orientation. No, for example, I have found that they ask you, what is your ethnic group? And you can have the option to answer or don't answer this option. So even when you answer this question, any organization can use this sensitive information to affect your life or to discriminate you. So because obviously this behavior could be punished, and because of this Data Protection Act. And till here, have you found this question that I told you that I have found in many forms? For example, the other day I was applying for a certification or something like this, and I needed to fill a form. And at the end of the form, they asked me about this sensitive information. Have you had the opportunity to see these options?
Yeah, we've got them in. We have expression of interest forms, and we ask them some of these questions.
And do you used to answer all the questions or not? Or what? And what do you think about this sensitive information? Do you think that is right that the companies or that some institution ask for this information, or do you think that this is a lot of information that you are giving?
Some of it obviously is good, because then you can split it up with the information you've got, so into sort of different groups when you're analysing the information. But obviously some of it is too much. Yeah.
Okay, so overall, I think that sex life or orientation, I can understand why a certain company needs to know that, but I don't know. I feel that this is too much information that we need to give. Okay, now let's move on to another regulation, another act that we have here in the UK. This regulation is wait, let me. Okay. Okay, so this other regulation talks about money laundering. Have you heard about the concept of money laundering, Kieran?
Yeah, it's sort of criminal thing where they put money through a business to make it seem like legitimate money rather than obviously criminally earned.
So basically, money laundering regulations are used to avoid this money that comes from illegal activities, no? That sometimes come from narco traffic or terrorism. So for that reason, in the UK, we have the Proceeds of Crimes Act, that is a regulation that includes all the money laundering laws or process to detect and to avoid money laundering. So basically, the institution that is in charge to regulate that all the institution, overall financial institution, are not using money from these illegal activities is the Financial Conduct Authority. Have you heard about the Financial Conduct Authority? Do you know what is the main purpose of this authority, Financial Conduct Authority?
Is it just to make sure everyone's sort of following the same rules and regulations?
So yes, Financial Conduct Authority is a government organization that protects and guarantee that most of the financial institution act according to the best practices, the ethic, the code of ethics, the Data Protection Act, the money laundering regulation, that all the companies follow the rules. So in terms of money laundering, Financial Conduct Authority is the body that supervises the compliance of most financial institutions with a money laundering regulation. And if you want to know more about Financial Conduct Authority, I put a link here in this slide to know more about not money laundering regulation, more about the activities of Financial Conduct Authority. So, in order to comply with the anti-money laundering, also we have another act called a Terrorism Act that banks and financial institutions must take. So it's not only the anti-money laundering, it's also another act very specific with money that comes from terrorism. An effective UK anti-money laundering policy, because for example, here in the UK, all the financial institution needs to have procedures to recognize activities that are very connected with anti-money laundering. So these procedures needs to have an anti-money laundering program. In this program, the companies, in this case, the financial institution, this anti-money laundering things or issues are very related to financial institutions. So financial institutions, when they receive a new client, financial institution, they need to do a very huge research about the person. For example, if the person has criminal reports, or what is the job that the person is doing, and a lot of personal information, in order to be sure that this person is not close or is not connected with any with some money laundering. Imagine if a financial institution receives a customer that is going to invest a very huge amount of money, the first alarm that the bank or the investment bank needs to see is, okay, what is the activity of this customer? Maybe the customer is, I don't know, maybe an entrepreneur, no, and they need to prove how this guy got this amount of money that he needs to invest in a bank, no? So this is kind of alarms, and for that reason, all the financial institutions have the very sophisticated programs to see and to search more about every client and every person, and even if they are politically exposed person. I don't know if you heard about, for example, a scandal called the Panama Papers. Have you heard about that?
No.
It was a scandal in which there were a lot of politicians, famous people, artists, singers that probably they were related with they were investing in another in another countries with to avoid taxes, and this money comes from illegal activity. So was a very interesting problem. Maybe it was like 5 or 6 years ago. So all these pairs, all these people was discovered. So was a very huge list that contains a lot of famous people that were involved in illegal activities, and the money that they received was investing in another countries with weak regulations. So for that reason, it's important that every financial institution has a very deep research about every client. So another thing that the companies needs to cover, needs to do to cover this money laundering regulation is reporting obligation. That is, firms must submit suspicious activities report. So if the bank detects an activity that is uncommon, that is not normal, they need to fill a report called a suspicious activity report to the National Crime Agency. Obviously, because this could be a potential money laundering activity. Another thing that the banks need to cover is money laundering reporting officer is a specific person inside the company, in this case inside a banking institution, that needs to be in charge of all the monitoring and all the activities to prevent money laundering. So every bank needs to have this specific person, this specific role inside the organization. And finally, an anti-money laundering training. And the banks needs to provide courses and knowledge about how to detect anti-money laundering how to detect money laundering activities, and how could be and how are the changes in regulation in case the regulation changes. Now, till here, I feel that this topic about anti-money laundering is very huge and very interesting. Unfortunately, we don't have a lot of time to talk more about this topic, but it's very interesting. If you have the chance to read this case that I told you, the Panama Papers, is like a policy. It's like I feel that this it happens only in the movies, but this was the reality. So if you have the chance to read this book, because I guess there is a book and the news, and then some authors created a book. So the book is called Panama Papers. It's very, very, very interesting. And now we are going to see the impact of a branch of ethics on accountants and business organizations. It's important, coming back to the topic of the code of ethics. It's very important that not only the accountants, I mean all the profession needs to cover a code of ethics. This because the recent scandals in financial world that has boost the necessity to have this kind of ethical guides to tell the professional how to react, no, and to guarantee that all the professionals works under a specific or a general set of rules and values. We have our last topic, that is understand the role of regulatory accounting bodies. We have here two topics: explain the role of regulatory bodies for accountancy in a specific country, and assess the benefits and limitation to an organization of using international accounting standards. So here in the UK, we have a body that is in charge to emit all the financial reporting standards, and this body is called Financial Reporting Council, which was given the powers in 2012, and is responsible for regulating accountants, auditors, actuaries, and the Financial Reporting Council promotes transparency and integrity in business in the UK. So basically, this is the body that emits all the financial reporting regulation in the UK. And also, the Financial Regulation Council has different bodies that has a kind of connection, and these another bodies that depend on the Financial Reporting Council receive different names. For example, we have the Association of Chartered Certificate Accountants. We have the Chartered Accountants of Ireland. So every country or every zone of the UK has a specific body that emits some certifications for accountants to guarantee that the accountants cover all the knowledge that they need to do their work. The most common certification here in the UK are the ACCA or the CIMA certification for accountants, that guarantees that an accountant has the knowledge required. This was in terms of accountants bodies, and in terms of international accounting standards, if we come back here, the Financial Reporting Council is in charge to emit financial reporting, but in the UK, financial standards, but in the UK, only in the UK. But we have another body that is in charge to emit international accounting standards, not only in the UK, in the whole world. So because these international accounting standards are in the whole world, these standards are more influenced by the culture and other socioeconomic economic and political factors, no? And so these international rules try to be more general, So in terms to get the similar results in each country, independently of the socioeconomic or political factors. International accounting standards are looking for harmonization to have the same picture of every country in order to compare financial information. And why? Because if we can compare the behavior of an entity or of a company in a country, and if we can compare this information with the same organization in another country, we are going to make a better decision. We can, for example, with this international accounting standard, it doesn't matter if you are an accountant here in the UK or if you are an accountant in another country, you can be able to understand even when you are an accountant here or in a country, maybe in India, because at the end it's an international set of rules. And additionally, one of the benefits of using international accounting standard is that this facilitates flexibility and efficiency. Because imagine if a country that is not using international accounting standards, they need to pay. Maybe if this company wants to do another business in another country, they need to pay to transform its financial statement in an international accounting standard in order to compare financial information maybe in a country that the company wants to invest. So if the company at the beginning uses the international accounting standard, this could be more efficient because the company would save time. So if at the beginning this company decides to use an international accounting standard instead a local standard. But what are the limitation of using international accounting standard? I feel that the most important limitation is that because of international accounting standards are very general and try to have the same picture independently of the country, they sometimes international accounting standard they don't pick all these differences or these specific things that every country has. So they are very general and they don't take these particular characteristics of every country or the environment of each country. So this is one of the limitations that they don't pick these specific characteristics of the countries. And another limitation is the cost, because obviously if a company wants to follow an international accounting standard, probably they need to hire experts of international accounting standards, and they need to have a specific program to change all the financial reporting to an international framework. So additionally, another limitation is the cost that the using of the international accounting standards could be implied. And okay, we finish here. We have like 5 minutes to see if you have any question.
No, I'm fine.
Okay, so if you have a question during the week, I feel that the university, the school is going to share with you this presentation, and additionally, the university is going to share the recording of this class. And if you notice that you have any doubts or any comments, or if you want to know more about a specific topic, please let me know.